Mahindra CIE Q4 and full year CY 2022 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Basudev Banerjee from ICICI Securities. Thank you, and over to you.
Yeah, thanks, Lizanne. Good morning, good afternoon, good evening to all the participants. Thanks to Mahindra CIE management for giving us the opportunity to host the conference call. I'd like to introduce the management represented by Mr. Ander Alvarez, CEO, Mr. K. Jayaprakash, CFO, Mr. Vikas Sinha, Senior VP Strategy, and Mr. Oroy Laffoy, Business Controller. Without wasting any time, I'd like to hand over to the management for the initial comments, followed by Q&A.
Yeah, thanks, Basudev. Thanks everybody for your time for joining on this call. I welcome all of you as well as Ander, our CEO. I will present MCI results for the Q4 C22 and full year C22. We follow the calendar year, just as a reminder. I will refer to the presentation that we have uploaded yesterday evening. So let me begin with some key developments in the year 2022, which are described on page 5 of our investor presentation. Our principal shareholder and promoter, CIE Automotive Group of Spain, increased its stake to 65.7% in C22, an increase of nearly 5%. The increase in shareholding shows the confidence CIE has in our company. The board of directors of MCIE at its meeting in December 2022 approved the proposal to change the name from Mahindra CIE Automotive Limited to CIE Automotive India Limited. India is one of the major growth markets that CIE Group is focusing on as part of its global strategy, and the name change reflects this. The name change will be executed once all regulatory approvals are in place, and it may take a few months. The board also took note of a proposal to actively look for a buyer for the truck forgings business in Germany. This will allow us to focus on the car forgings business out of Spain and Lithuania, especially managing the transition that we are seeing in the car business in Europe to electric vehicles. Accordingly, the truck forgings business in Germany has been classified as held for sale. We are not presenting the details of the truck forgings business in the Q4 C22 and full year C22 results. The details of the operations held for sale are presented separately. The name of the German truck forgings business was also changed to CIE Forgings Germany, and we call it CFG in our presentation as well as in this talk. With these 3 key highlights, let me proceed to 2022. The year 2022 has been an excellent year for MCIE. Let us look at the results in detail. The Q4 C22 results for MCIE India. We know that we operate largely in India and Europe, so our results are along India and Europe. The Q4 C22 results for MCIE India are on page 7. While 4-wheeler and truck demand was good, 2-wheeler was very weak in Q4 C22, and tractor suffered from a high base of last year. Sales in India in Q4 C22 were INR 13.4 billion, which was 26% higher than same quarter last year, but lower than Q3 C22, about 6.5% lower sequentially. The sequential drop happened because the Diwali season this year was in the 3rd week of October, and large part of festival-led production happened in September. The India operations achieved an EBITDA percentage of 18.5% in Q4 C22 versus 12% in Q4 C21 and 15% in Q3 C22. Please note the Q4 C22 EBITDA includes a positive impact of INR 378 million of profit on land sale. Without this, the recurring EBITDA margin in Q4 C22 for India was 15.7%, still higher sequentially by 0.7%. Also note the Q4CY21 EBITDA margin had a one-time VRS cost that lowered margin by 1.2%. Even if we adjust for one-time effects in both the quarters, the Q4CY22 margin is much higher year-on-year than Q4CY21, 15.7% versus 13.2%. And this reflects the fact that the Indian operations continue their journey to match the global standards of the CIE group. On page 8, we have the results for MCI Europe in Q4CY22. These financials don't include the German forgings business, CFG, which have been held for sale. The Q3CY22 and Q4CY22 numbers have been stated accordingly. Sales of INR 7.3 billion in Q4CY22, which are 43% higher year-on-year versus Q4CY21 and 7.5% higher than Q3CY22 sequentially. We have clearly beaten the market with European light vehicle production growing year-on-year by 6.6% in this quarter. EBITDA margin in Q4CY22 was a healthy 14.5% higher both year-on-year and sequentially. That is versus the 11.1% in Q4CY21 and 13.5% in Q3CY22. Margins improved as some of the increases in energy and inflation were passed through and the energy prices are starting to stabilize. On page 9, we see the consolidated MCIE Q4CY22 results, which are a combination of the good results in India and Europe. Consolidated sales were INR 20.7 billion, 31% higher than Q4CY21. EBITDA INR 3.55 billion, 92% higher year-on-year. EBIT INR 2.78 billion, 135% higher year-on-year. And EBT INR 2.7 billion, 145% higher year-on-year. The full year C22 results for our Indian operations are on page 11. Sales increased by 29% versus C21 to INR 52.5 billion. This was higher growth than the underlying market. As said earlier, the four-wheeler and truck markets did very well, while tractors were sluggish on a high base and two-wheelers continued to be weak. This trend is going to continue. The EBITDA margin of 15.9%, EBIT margin of 12.0% and EBT margin of 11.9% are all much higher than C21. This reflects strong sales and margin performance. Please note the effect of one-time cost on C21 and C22 results as explained earlier. The PAT percentage in C22 is 9.1% versus 3.9% the previous year. The C21 PAT percentage was affected by the one-time negative impact of roughly INR 1,426 million of deferred tax liability on Bilforge goodwill. So please adjust for that. Looking ahead, we expect the growth momentum to sustain in India for the next few quarters. Our order book in India is in line with these expectations and we have been adding capacities in almost all our verticals. In India, we are balancing order book requirements and investments in capacity such that both growth and profitability objectives are met. On page 12, we have the full year results of C22 for our European operations. These are without CFG, held for sale. With sales of INR 29.8 billion, there has been a 27% growth vis-a-vis full year C21, much higher than underlying market growth. EBITDA margin in C22 was 14.5%, EBIT 11.4% and EBT 10.9%, all slightly lower than C21, largely on account of the unprecedented increase in energy costs. C22 PAT is negative INR 6.6159 million and that includes INR 8475 million of losses coming from discontinued operations. In Europe, we expect the market to start recovering very gradually and are focused on improving our profitability. On page 13, we have the C22 consolidated results of MCIE. Sales was INR 82.2 billion, which is a growth of 28% versus C21. The EBITDA margin was 15.4% versus 15.2% in C21. EBIT 11.8% versus 11% and EBT 11.6% versus 10.4%. All one-time effects have been explained earlier. The consolidated PAT is negative INR 1362 million, which is minus 1.7% and includes INR 8475 million of losses coming from discontinued operations. About INR 2 billion of positive exchange rate impact on CFG goodwill and net assets is pending to be allocated to the P&L account in 2023. This will be done once the CFG sale transaction is completed. The note explaining the impact of holding CFG for sale is shown on page 14 separately. This note is also part of the result statement submitted to the stock exchanges and SEBI. We have already explained the details earlier in this talk. On page 16, you will see our abridged consolidated balance sheet, which shows the healthy state of MCIE. Return on net assets is 17.9% and return on equity without the goodwill write-off is 15.3%. Net financial debt is INR 1444 million, that is roughly 145 crores. The cash flows are shown on page 17. The company generated operating cash flows to the extent of 73% of consolidated EBITDA, which is very good. Growth capex was INR 3.5 billion, and this is without maintenance capex. And this was largely focused on projects in India, some of which are highlighted later on pages 20 and 21. Overall capex was 5.6% of sales, which is in line with our norms. While our consolidated PAT is negative on account of classifying CFG as held for sale, our cash generation has been good in C22. Taking this into account, the board of the company recommended that dividend payments be maintained. Accordingly, MCIE will pay a dividend of INR 2.5, that is rupees 2.5 per share after the approval in the AGM schedule later in the year. Pages 20 and 21 present some operational and commercial highlights of C22, some of the new photographs of the new plants added. Pages 22 and 23 give details of geographic and technology-wise breakups, market segments, and key customers that we operate with. Page 24 provides details of our electric vehicles portfolio. Electrification of powertrains has seen rapid adoption in Europe. Market share of battery electric vehicles has crossed 10% there. And it is getting to become more mainstream in India as well, especially in 2 and 3-wheelers. We have developed a good order book for EV parts and are working with major European and Indian OEMs in the EV space across segments. Our EV order book covers aluminum and steel forgings, gears, stampings, and composite parts for E2-wheelers, E3-wheelers, and E4-wheelers. So the photographs of some of the parts are there. Page 25 summarizes our overall strategy, which has remained unchanged from previous years. Our strategy is based on the global strategy of CIE Automotive Group, the global strategy, which has a track record of success in 4 continents, Europe, North and South America, and Asia. Pages 27 and 28 provide a report card on the effectiveness of our strategy. On page 27, we have shown revenue and EBITDA margin trends for our Indian and European operations since calendar year 2016. Which was the first full year of reporting results. Revenues from India have grown 3.2x between C16 and C22, and this includes 2 acquisitions. Revenues in Europe in C22 are 0.9x of that in C16, but this does not include CFG, which has been held for sale. The share of India in consolidated revenue has grown from 33% in C16 to 64% in C22. EBITDA margin in India has grown from 11.5% in C16 to 15.9% in C22, and that in Europe from 10.9% to 14.5%. Page 28 shows similar trend for consolidated results. Consolidated revenue has grown 1.6x, EBITDA 2.2x, and EBIT 3x between C16 and C22. EBITDA margin has increased by 430 basis points and RONA percentage by, that is return on net assets, by 890 basis points in the same period. Page 29 provides a snapshot of our stock market history since 1st January 2015. The next few pages talk about market statistics and forecasts from relevant sources, followed by the results submitted to SEBI in the prescribed format. The MCIE team is confident that it can utilize future opportunities and face future challenges with agility in order to meet the shareholders' expectation of sustainable growth and profitability. With that, I would like to thank you and proceed to Q&A. Vasudev.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, please, we will wait for a moment while the question queue assembles. The first question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. Congrats on good set of numbers. Quickly, a couple of clarification. One is with respect to the European business, can you talk about the growth in euro terms, constant currency growth?
For the quarter or for the year?
For the quarter and the year.
Yeah. So I think for the year, volume term growth would be about 11%. And for the quarter, Oroids, can you help me with that?
Yes. For the quarter, the volume increase has been 40%. As we have had a negative exchange rate impact of 3%. But volume increase has been approximately 40%.
Okay.
14.
Oroids, is it 40 or 14?
40.
40.
Okay.
40.
Okay.
40%.
And this is the volume growth, tonnage growth.
Yeah. Without exchange rate, without raw material.
Okay. Cool. Second clarification was with respect to the India business financials as given in PPT. So which line item would the revenue, the gain on sale of land would be accounted for? Would it be in revenue or operating other income?
Which one? Which plan?
The gain on sale of land.
JP, which line item in the SEBI result takes into account the gain because of land sale? Hello?
Sorry, Vikas. I was on mute, Vikas.
Sorry. So you heard the question.
Yeah, I heard the question. Sorry. It is shown as an exceptional item. It is neither in sales nor in other operating revenue.
In the PPT, India financial, because I could not see any exceptional item
Part
there.
of EBITDA. In the PPT is part of EBITDA.
EBITDA. So it will also be part of revenues, right?
Not revenues. The revenue
Just EBITDA.
is purely product sales.
Okay, got it. Okay. And in terms of the question which I have regarding the business, one is we have seen a very sharp improvement in profitability of CV forging business, which is held for sale. So anything structural which has changed there, or that there is any one-off there?
Mm-hmm. So can I take that, Vikas?
Yes, please.
Yes, JP. So yes, we have exceptional write-back this quarter for certain employee payouts that were planned because of volume drop expected. But since contracts have been signed, those provisions are no more required.
Okay.
Some settlement of prices from backdated. So they are exceptions. Almost 7 million out there, 7 million euros.
Okay. Got it. And last question pertains to what we have seen on the aluminum forging side. We have mentioned about we have started supplies there. So can you talk about what kind of order wins we have? How has been the response from customers for this new product category for us? That will be my last question.
So, Ender, the question is, what has been our experience with aluminum forging so far?
Okay. Yeah. We are actively quoting several projects in the aluminum forging field. We are developing these products commercially, and we have got, as you all know, and we already informed, we got already our first business, and we are already producing the first products in this technology, and we are, let's say, sure that in the next quarters, in the next month, we will be able to get additional projects and develop this business. Okay, so we are planning to make this transition from our combustion engine components to this, let's say, new technology that we will prepare and we will manage to make this a smooth transition in the next years. Okay, so the process is going, I think, quite well. We have already started, and the expectations are also optimistic.
Got it. Thanks. I'll come back in queue.
Yeah, thanks, Jinesh.
Thank you. The next question is from the line of Siddhant from Goodwill. Please go ahead.
Yeah, hi. I just had one question regarding the dividend policy. My assumption was that there would be around a 200 crore payout or 25% of profit. Is it because of the write-off that you've chosen to give a lower dividend, or could you give a future guidance on the dividend policy?
JP, will you take that?
Yes. Yes, you can explain, JP.
Yeah. You're right. We have a dividend policy where we say 25% of PAT, but since we have a negative PAT this year, we have chosen to continue with the last year dividend that we had declared since we started only last year. But going forward, our policy is very clear on what we want to do.
Okay, so next year we can expect 20-25%.
Yes. Okay. Yes, absolutely.
Yeah, that's it.
Yeah, thanks, Siddhant.
Thank you. The next question is from the line of Pratik Kothari from Unique Portfolio Managers. Please go ahead.
Hi, good afternoon. So my first question on the India business, I believe in the last quarter call earlier our stated guidance or expectation used to be that we'll outperform Indian markets by 5-10 percentage points, but then I guess last quarter we revised it that we'll do at least 10% of outperformance, and we have seen that happening here. If you can just highlight what is driving this outperformance or regaining market share, etc.
Yeah, I'll take that. Yeah, thanks, Pratik. So if you look at the weighted average for the year, full year, I'm talking about the full year, the weighted average growth rate, and you have the segment-wise breakup for India. About 49% is four-wheelers, 23% is two-wheelers, 20% tractors and construction equipment and so on, and roughly 8% is trucks. These are rough, overall rough numbers. So if you do a weighted average calculation based on these numbers, that would be 14%. Against 14%, we have done 29%. Some of it is, of course, raw material, which this year would be lower. Where are we getting it from? We have to understand a lot of our anchor customers are growing. M&M, Tata Motors, Maruti, they are growing. M&M both in light vehicles as well as tractors. We have been, getting more orders in areas where, we were earlier less present, like Hyundai, Kia, John Deere, even in Tata Motors. So we are increasing our presence, and we have been adding new customers. So all three parts are there. Large part of the growth and also exports, especially from AEL, Aurangabad Electricals. So these would be the drivers that has allowed us to grow much faster than the market. We expect some of these trends to continue. As we have pointed out, we are adding capacity for the last 1-2 years, and this year also. We will be adding capacity in almost all our verticals. And we are careful because we want to balance both growth and profitability objectives. So that is not really a problem for us at this point of time. So balancing investments and profitability is our key focus at this point.
Fair enough. So my second question on Europe, I believe in the middle of last year our expectations, and I believe that was also the IHS forecast, that second half could be better than first, irrespective of holidays, energy prices, etc. But that hasn't panned out. So one, your comment on that, and second, the outlook for next year in Europe especially.
I'll give you the overall numbers and then I'll request Andrew to comment on the European market. Of course, we have outgrown the market in Europe also quite handsomely. You saw the volume growth numbers that Oroid said, about 40%. In Q4, the growth numbers in the light vehicles market was 6.6. So it is much higher than that. A part of it is because of Metal Castello. Going forward, what is the forecast? I think this year we ended up in light vehicles at about 15.2 million units production. That is expected to go up to 16.1 or 16.2, something like that. So that is the kind of growth. So 6, 7, 8% growth is expected in Europe this year. So this is from a market perspective. But from a more business perspective, I'll request Andrew to talk about, how he looks at the European market.
Okay. Yes, it's true that in global figures in calendar year 22, the market performance especially in the light vehicles was quite disappointing because we were all expecting certain growth, but unfortunately, mainly because of the Ukrainian war plus the semiconductor shortage that still remains, we were not able to, or we saw a market going down a little bit in calendar year 22. Okay, for calendar year 23, we expect the market to recover, at least as Vikas said, we can expect between 5 to 8%. Certain recovery that was expected. Of course, this is providing the Ukrainian war and let's say the frictions with Russia will not create additional disturbances in the market. Okay, that is probably one risk factor that we all have in mind. But we see the economy recovering. We had certain fears of recession in the economy in Europe. It seems that this is not happening, and also the inflation is going down. And the most important point that I think is affecting our day-to-day business is that the energy prices are also being stabilized, and we are now at the electricity cost is approximately now at 140 euros per megawatt when 3 months ago we were at above 300 euros per megawatt. Okay, so considering all this scenario, we think that the 2023 will be a good year. We will see increase also in our activity, both in Metal Castello, CIE forgings. We see a strong demand in this moment. We expect a good year also. And let's say that the 23-24, this period, we will see the recovery that we didn't see in the last couple of years due to the semiconductors and the Ukrainian war. So we are moderately optimistic for the next couple of years.
Great. And I mean, the outperformance in volume versus European market is outstanding. So hearty congratulations to the team there. Just on that part again, so this additional wallet share, the business that we have won against the industry, against the smaller players, we were talking about consolidation earlier. So how sustainable, I mean, obviously this doesn't happen every year, but whatever extra that we have gathered, I mean, how sustainable is this?
And so the question is, since we have grown much faster than the market in Q4 especially, that means that we have gained from smaller suppliers. So a bit of market consolidation is happening. How much of that is sustainable, or we'll lose some of that going forward?
Okay, let's say that we think that this trend will continue in the next years. Okay, I mean this year perhaps was quite relevant or higher than even what we expected. But for the next years, we think that this consolidation will continue. Okay, this growth, especially in the let's say the automotive passenger forgings activity, will continue, and we will see certain improvement from that side. That's our expectation. probably at a lower pace than in the previous year. Okay, so that is also a reality. And regarding the growth coming from Metal Castello, that was last year, we had a big jump on Metal Castello, the gears business that we mainly are exporting to the US. This market is doing really well also, and we expect to continue this growth trend, especially because we have been awarded with additional new programs. So we are quite optimistic on that. Okay, the key point here is that we are adding capacity to full and to cope with this additional demand, because in this moment our capacities are almost full. Okay, so that is the comment that Vikas made before regarding that we need to align our capacities to the demand, and we are taking care of that capacity increase in our verticals.
Great. Good to know. So last question is on the other operating revenue. I mean, that has doubled over the last 2 years, and that I believe is largely scrap sales. You can just highlight what it is, because it's a material number now.
JP, other operating income has doubled in the last 2 years. Any comments on that? It is largely scrap, that's correct.
No, it is largely scrap, but the doubling is actually a reclassification of all the energy compensation that we are getting from customers were credited to the power and fuel expense in other expenses line, because that was more a sharing of expenses in terms of concept, with the customer. But from an accounting point of view, it had to be reclassified to other operating revenue. So you see increase in other expenses as well as increase in other operating revenue.
Oh, okay.
Otherwise, the other operating revenue will remain at the previous quarter levels.
Okay, sure. Thank you and all the best.
Yeah, thank you so much.
Thank you. A reminder to the participants, anyone wish to ask a question, may please press star and 1. The next question is on the line of Nemish Shah from MK Investment Managers Limited. Please go ahead.
Yeah, thanks for this opportunity and congratulations for a very good set of numbers. So I had a question on the Europe business and specifically on the margin front. So if I compare CY21 margins ex of German business, so we did about 17.2% EBITDA margins in CY21, and we have closed at about 14.5% in CY22. Now, given that the inflationary trends are largely stabilizing, and we expect some pickup going forward as well. And so do we anticipate us inching back to those CY21 level margins in the coming financial year?
Okay, let's say that you are right that we had this margin reduction from calendar year 21 to calendar year 22, and there are two main reasons. Okay, one is the raw material growth, raw material prices inflation that are passed through. Almost 100% of the cost increase is passed through to the customer, but without any margin. Okay, so that dilutes our margins. Approximately 1% is coming from that effect. Okay, the second main effect is, as you know, and as we have already mentioned, is regarding the energy price increases. I mean, electricity and gas prices went up dramatically during calendar year 22, and this impact, this was we negotiated and translated and transferred to the customer only partially. Okay, it was a big discussion on this passing through process, and part of this was absorbed by our accounts. Okay, so that's the second main impact that we had last year. Okay, so regarding let's say the evolution of these margins during calendar year 23, what we think is that the raw material effect will continue because it seems that in Europe there will be a certain additional increase on steel prices. That is our main raw material in these verticals. So we will have this disadvantage in margins in calendar year 23. But on the other hand, regarding the electricity and gas prices that are going down and are stabilizing, as I mentioned before. So I expect that we will recover certain margins coming from that concept. Okay, so let's say that we expect certain recovery, but not all, because of this raw material increase that is continuing going up.
Okay, understood. Yeah, that's it from my side. Thank you.
Yeah, thanks, Dinesh.
Yeah.
Thank you. The next question is from the line of Sunil Kothari from Unique PMS. Please go ahead.
Thanks for the opportunity, sir. My congratulations for good performance as well as for taking decision on selling of this German forging business, which is very difficult decision for CIE because our record is always to turn around any difficult acquisition we make. But finally, we have taken this decision, so my hearty congratulations for that. Sir, my question is on this. Since last 3-5 years, I'm hearing from Mahindra CIE, external some speaker of say some auto giants, automobile companies, auto parts, that ICE engine parts will be the very big opportunity for companies like Mahindra CIE. So would like to understand that this opportunity has already arrived and that's why we are outperforming, or you see much more opportunity from this international combustion engines parts globally, because locally we are doing really well, but outsourcing exports, how big those opportunity and how prepared we are, and how you see those happening now?
And the question is, as electrification happens in Europe, whatever ICE parts that are left, internal combustion engine parts are left, will Europe transfer or outsource them to India? And therefore, there could be a big opportunity for Indian operations to export internal combustion engine parts to Europe, say in the next 5-7 years or whatever.
Yeah. Okay, we don't see this transfer of production from Europe to India, as we see India internally, just with the internal demand and the internal growth that we are seeing in the local market in India. We think that we will have full opportunity to continue our growth strategy. Okay, so we don't expect the moving production from Europe to India at least in the next years. Okay, perhaps in 8-9 years later on could make sense to concentrate all the internal combustion engine components in India, but not in the short term. Okay, so in the short term we think that there will be a consolidation in the market in Europe. So some of the players will be eliminated. So there will be certain winners that will consolidate the remaining market. That is our aim. So that's first the strategy. Then also we are developing additional products for, let's say, with other technologies, as mentioned before, let's say all these aluminum forgings. So we expect to do this a smooth transition. So that is probably the key point for our next European business evolution. The key points are this transition, consolidation plus transition. That will be the strategy. But the movement from Europe to India is not being considered in this moment.
Right. So second question is, our parent company has some goals and objective by 2025 for some growth rate and having over 19% EBITDA margin. So I understand Mahindra CIE also follow those type of goals, ambition and objectives. Which are the hurdles or which are the challenges which you should overcome to achieve those type of numbers? May not be 19, but maybe 17, 18, 19, whatever. and what you are doing for that.
Mm-hmm. Okay, what we are working extremely hard is in the improvement of our operations. Okay, you have listened to me in the previous calls. We always talk about our efficiency improvements and productivity improvements, where we can be competitive and profitable in all our verticals. Okay, during all these years we have improved, and you have seen the calendar year 22 results, and we also expect to continue this improvement trend in the next years. So as you also know, we want to be at the same EBITDA and profitability margins than our parent company. I mean, we need to be at that level in this 17%, 18% EBITDA margins. Those are our midterm targets. So we continue improving. Just as an example, this calendar year 22, our added value per employee improved about 15% improvement in this productivity ratio. That is really important. So for next year, we even want to continue this improvement even further than this 15% that we got this calendar year. Okay, so the difficulties on let's say the hurdles that we see in this process is that let's say that the mentality and the production style in our Indian verticals is less efficient than in Europe, and we would like, and we are trying, and we are, let's say, making this transfer of technology and continuous visits from our technicians and management to Europe to learn about our strategies and how we manage our plants, to transfer these best practices. And I think this is paying a lot of results. Okay, so this trend will continue, and we expect to continue improving our margins in India.
Great, sir, for very detailed answer. Just last question is on this German operation which we are planning to sell. What is the challenge to get the buyer, or we already have found somebody? Should throw some light.
Okay, you know that we took this decision in the December's board in Mahindra CIE. Since then, we have received several expressions of interest of several companies, and we are preparing the documentation. We are, let's say, exchanging information with these interested parties, and we are developing this process. Okay, until now there is no additional information to share, and during next month, when we advance in this process, we will inform accordingly.
Great, sir. Wish you good luck, and thanks a lot. Thank you very much.
Thank you.
Thanks, Sunil.
Thank you. The next question is from the line of Rahul Shah from Crown Capital. Please go ahead.
Hello. Yes.
Yeah, hi, Rahul.
Hi. So yeah, I heard previous answer about how you.
Hey, Rahul, you are very faint. Can you speak up a bit?
Hello. Is it better now?
Yeah, much better. Please.
Yes. So I was just pointing back to the answer that sir gave previously about improving margins and the strategies you are following and how you continue to maintain a trend. So on the similar lines, are we to expect as investors that from here on for CY23, everything will be maintained, like from revenue front, from the EBITDA margin front? So we will be able to maintain the numbers, and it will only be upwards from here on.
Rahul, you are asking a very difficult question. Whether, of course, we will try to maintain the trend as Ander pointed out. As he pointed out, our parent margin is higher. The previous question was that the parent is targeting 18 to 19% EBITDA margin. We are still some distance away. So our midterm target, as Ander pointed out, is to come as close as possible to CIE global target of EBITDA margin. So that trend will continue. Your second question around growth, whether we'll be able to maintain the same growth rates is something that I will not comment on. But I'll talk about both the markets that we have. In India, we said that our key challenge in India is really not order book. Our key challenge in India is to balance order book requirements and investments. So we are quite comfortable on the growth aspect. What we are focused on is to balance growth and profitability. And in Europe, Ander pointed out, there is a consolidation happening on IC engine parts, and therefore there are growth opportunities in Europe beyond just market growth. So with these two factors, I will suggest that yes, we'll continue on the growth trajectory, but whether it will be same, different or not that is a question I will not answer. But yes, we will continue both on our margin improvement and growth trajectory. Is that sufficient, or you would want some more clarification?
No, that will be all. Thank you, and all the best to you.
Thanks, Rahul. Thanks for your question.
Thank you. The next question is from the line of Aman Agarwal from Carnelian Capital. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. A few questions from my side. Number one, it was on the German forging business. This question is in continuation to the question asked by an earlier participant. Given the current macros, weak macros in Europe and globally, have they set any internal timeline of by when we basically want to dispose of this business? That was my first question.
No, Aman, there is no such timeline that we are talking about. Our board has noted that we need to do this. We need to execute this strategy, and as Ander has pointed out, there have been several expressions of interest. So it is our endeavor to execute this as quickly as possible, and as and when some developments happen, we'll keep you updated. But at this point of time, if with your permission, this is the kind of update that we have.
Understood, sir. The second question was on the India business. We were talking about 5 to 10 percentage points higher than the industry growth rate. That is our target for the India business. But if you can touch upon which segments which we want to focus on, we are present across the categories, forging, casting, and all. So which specific segment are we more focused on in growing faster than the industry, and which we want to grow more or less in line with industry? If you can touch upon it.
Again, and I will take you back to the question Rahul just asked, because he asked the same, whether the trend in growth will be maintained. Right now, the four-wheeler market is doing exceedingly well. As you know, it is perhaps the best year that we have had in a very long time, 2022. It's actually higher than 2018, which was the previous high. And within the market itself, some of the customers that we work with more closely, M&M, Maruti, M&M and Tata especially, and Maruti in the later half of the year, they are also doing well. Plus, we are increasing our presence with Hyundai and Kia. So to that extent, four-wheeler market is one area that is doing very well for us. Two-wheeler market, we have a strong presence, but the two-wheeler market is, just grew about 2 or 3% this year. And therefore, and in the two-wheeler market, I think Bajaj is our anchor customer. And because of Bajaj is very export-oriented, I think exports, because of the currency crisis, especially in South America and Africa, Bajaj exports are little muted. So to that extent, two-wheeler will continue, maybe not very big growth for us. Tractor market again has been doing very well, even though tractor market in C22 was some, like maybe 2% lower than C21, but the base is very high. I think the production in both C21 and C22 actually crossed 1 million, which is a very big number in tractors. So that base we think will continue in tractors. So tractors is again a very, a very good area for us. Trucks, the base has come down very strongly, even though on a low base, trucks grew well. I think almost more than 20%, and this year also, all forecasts are suggesting at least 10% growth. So truck market is growing, but on a low base. So four-wheelers, yes, is one area where we think we will benefit. Largely not only because the market is growing, but within the market, some of our key anchor customers are growing, and within the anchor customers also we have been doing well in terms of new orders that we are getting from them, and we have talked about, say, whether it is M&M or Tata Motors, we have talked about it in the past. So right now, that is the situation why we think we are confident that to answer both you and Rahul's question earlier, that we are confident that the growth trajectory will continue. Whether at the same level, I think this year we grew by about 28 or 29% in India. So whether that kind of growth trend will continue or not is something we have to see. But the direction is, yes, we will benefit from growth in the market, as I've talked about segment-wise.
Great. Thanks for an elaborate answer, sir. My question was mainly from the technology point of view. Like we are present in forging, aluminum casting, iron casting, stamping, composition, all these segments. So within this, which are the main technologies we will be focusing on in terms of growth? And this was coming from the point of view that we want to increase our margins in the India business.
Mr. Agarwal, so there's a lot of echo from your line.
It is better now.
Yeah. Aman, so you are saying among forging, casting, is there one area that we are focusing on? Oh, sorry, I took it the other way, whether we are focusing on some segment. In fact, when it comes to technology segments, I think we are, we are focused everywhere. So it is not as if we are focused only on this or only on that. And, let me just elaborate a bit, forgings, both in Bilforge as well as in, our forging Chakan plant, we have added capacity. Bilforge, we have talked about CIE Hosur in the past. In forgings, we have added presses. Last year we talked about in foundry, we had, refurbished our oldest and largest molding line. Magnetics, we are increasing capacity. In gears, we have put up a new plant. In AEL, we have put up a new plant. In stampings, we have been doing a lot of robotic automation, which will help provide value-added welded products. So, it is across the board. That is why I have given at least one example from each vertical to show that growth is happening across the board. It is not really restricted to any one vertical. So we are not really focused on only one vertical. That's why I talked about more market segments. So sorry for that.
Got it, sir. Just one final question from my side. In past con calls, 2-3 years back, we have talked about merging our global forging businesses and also about acquiring a plastic business in India.
Sorry to interrupt, Mr. Aman Agarwal. Sir, your audio is not clear. We're not able to hear you clearly.
I am able to hear, ma'am. So, so his question is, a few years back, we had talked about merging the Brazil, Mexico, China forging business of CIE. What has happened to that? Frankly, when after the pandemic came, we have not pursued that proposal. So as of now, we are not pursuing that proposal. That's the answer to Brazil, China, Mexico at this point of time. In fact, the priorities are different. There has been, EV transition is happening, so all of us are focused around that. And perhaps we will, I don't think we'll go ahead with that proposal. And to your next question about M&A in plastics, yes, plastic continues to be an area where we want to look for acquisitions. And we continue to look for it. If there is anything of interest, at the appropriate time, we'll let you know. So that The strategy continues. We have not been able to proceed on that.
Thank you, sir. This was really helpful, sir. Thank you for answering my questions.
Yeah. Thanks, Amal.
Thank you. The next question is from the line of Naveen Mata from Mahindra Manulife. Please go ahead.
Yeah, thank you for the opportunity and congrats for strong results. Just a question on the energy cost. You did comment that prices have come off from 300 euros per megawatt to about 140 currently. I just wanted to get a sense in the quarter forward, what would have been our consumption of energy cost at? Would it be higher and there could be some benefits that should flow through going forward?
No.
Okay. Yes, because go on, please.
No. Naveen, I was just asking if the question is what percentage of our cost is, or what percentage of sales is energy cost? Is that what you're asking?
No, sir. I was trying to understand what was our energy consumption cost in the fourth quarter, because I'm sure it's come down from 300 to 140 over the last quarter, but we would have consumed at a higher level. So I'm just trying to understand what benefit can flow through as we get closer to this 140 in our production cost.
So absolute power cost in Q3 and absolute power cost in Q4, right?
Yeah, that's also fair.
Yeah. So Ander is asking for total energy cost in Q3 versus Q4.
Yeah. I don't have the details in this moment, but the trend during the Q4 last year was in October we had something like 300 to 250 and 300 euros per megawatt. Then November was reducing, and in December we finished at approximately 150, something like that. Okay, that is so the average you can take that
right.
Could be around 250. Okay, then for this quarter, for this start of the year, in this moment we are at about 140 euros per megawatt. That is the trend, and it's quite stable in the last weeks. So we can expect, and this is positive because this will let's say reduce also the impact of the energy in our accounts. Okay, so that was the effect that we expect to be positive in our margins thanks to this effect.
Got it. Thanks for that. And just one question on our European operations again. We've showcased new products and we are gaining new orders. So I'm just trying to understand over the next 2-3 years, how should we think about our revenue mix between ICE and EVs? This is specifically for Europe.
Okay, I think we will see the transition, in a smooth transition from let's say this calendar year 23, where the total electric vehicles market share is approximately 10%, to what we expect to be above 60-70% in 2030. Okay, so we will see this transition. What we are now we are getting new orders from our customers, and just for example, last year, approximately 30% of our new orders are from electric vehicles. So what we expect is that there will be a transition, and our share of electric vehicle components will continue or will go increasing smoothly during this period. Okay, it's difficult to give you a figure because the evolution of the market is unknown, and the start of the new projects is usually being delayed. Okay, especially when there are new technologies. Okay, you can see the evolution of the new electric vehicle plants in Europe is being delayed by the OEMs, mainly because of the technical reasons, also the supply of the components, battery components, and all these kind of things. Okay, so my expectation is that we will have this smooth transition and increase on this share. and also the expectations are good or optimistic, mainly because of the new order share on electric vehicles is becoming higher and higher every year.
Understood. That's it from my side. Thank you so much.
Thank you.
Thank you. The next question is from the line of Basudev Banerjee from ICICI Securities. Please go ahead.
Thanks. Couple of questions from my side. One question from the point which Naveen was discussing. So at a steady
sorry,
state...
Mr. Banerjee. Sir, can you use the handset mode while speaking?
Yeah, audible?
Much better, sir. Thank you.
Yeah, so one question, just wanted to know, like before last 1 year when this power price moved to 400 euro per megawatt hour, as you said, when it used to be at those steady levels, what was the energy cost as a percentage of revenue at that time? And how much it moved up to at its peak?
And that is only for Europe or for consolidated?
Only for Europe business, yes.
So, Rohit, the question is, what was the power cost as percentage of European sales before the energy cost started going up? What was the max it went up to, power cost as percentage of sales, and how much is it stabilizing at?
Before it went up, it was approximately 5%. With this increase, that went up to 8% more or less on the sales.
Vikas, if you can repeat again what Rohit said.
So it increased by about 5%, Rohit, is that right? It increased by about 5%, and now it is at around 8%, you are saying.
So it went from what level to what level? That 5% increase was from which level?
So, Rohit, we couldn't hear you. When you say 5% increase, what was the level before the increase?
It was more or less 8%. It was 10% over the sales.
Mm-hmm.
And now it has gone up to 8% over the sales, more or less.
So it has come back to 8%, is what you are saying?
Yes. The reference level before this energy increases went up was around between 60 to 80 euros per megawatt. That was the previous electricity price in Europe.
So Basudev, we'll clarify this a little later, because, we are not able to hear properly. So we'll clarify this later.
Yeah. And second question, sir, like as you duly mentioned that because of the goodwill write-off of the truck forging, those one-off accounting aspects, dividend was limited to 2.5 rupees this year. And with normative free cash flow again starting to come back from next year or get enhanced, along with some potential value seeping in through selling of that asset. So that extra cash flow on one side. And on the other side, in the December press release, you also mentioned that larger focus on European EV lead component space. So if you can highlight any specific technology aspect or strategy aspect, how are you looking at European EVs or in terms of acquisition? So what's the way ahead other than what you are doing presently?
No, Basudev, we will continue to do whatever we are doing. As Ander has pointed out, we do expect a smooth transition to EVs. As we have been saying, the EV transition in Europe is being led by the same companies that we deal with. So to that extent, that transition is a bit easier. So what we are seeing is a twofold thing. We are getting more and more new orders in the EV space. The new orders as percentage of overall orders that we get is increasing. And number two, we are also getting, because of consolidation, a higher share in the IC engine market. So both these factors will continue for some time, and I think at this point of time we don't require any special effort like doing an M&A or something. We just have to manage this transition. Ander, would you like to add anything more to this?
No, nothing
Yeah, because exactly that's what I was trying to understand. To grow and expand European business through the EV route, you need some external capability addition, or organically you can grow. So that's what I was trying to understand.
No, we can grow organically, no problem.
Okay.
The only new technology we are adding is aluminum forging, and that is going on, as Anders pointed out.
But that is anyways a part of your 6% capex to sales outlook.
Yes, exactly. No, there is not too much capex required in aluminum forging. I think in a previous call, Ander had pointed out, it is largely the allied, machines that are required, heat treatment and finishing and so on and so forth.
One of your key competitor who has also entered the same field almost 2 years back is still grappling with capacity utilization and making EBITDA losses. So how to look from that angle then?
Yeah, it's a journey for them and us, for both. So that's okay. As we have to manage this transition.
Sure. Okay, sir. Thanks.
Yeah, thanks, Vasudev.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments.
Yeah, thanks. And I'll hand you over to Anders for his closing remarks.
Okay, so thank you all for your participation in this call and your well-directed questions. I hope we answered properly and you felt the real performance and value of our company. As always, I want to thank you to all Mahindra CIE team for the commitment and fantastic job during a very complicated year. So thank you very much, everybody. Thank you.
Yeah.
Thank you, members of the management team. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.